If you're an investor, these are confusing times. On one hand, Warren Buffett is sitting on a massive cash reserve, over $270 billion, possibly waiting for the perfect moment to buy up undervalued stocks. On the other hand, there's a growing concern about hyperinflation, government debt spirals, and even the possibility of a market collapse. And from the looks of it, it could be going any of the two ways. How could that impact everything from stock prices to the cost of everyday goods? Where does that leave you as an investor? Should you follow Buffett's cautious approach, sitting on cash and waiting for opportunities? Or is it time to prepare for something far more extreme, like hyperinflation wiping out the value of your savings? Stick around, because I'm going to walk you through both perspectives. Buffett's long-term optimism and the growing warnings of hyperinflation, and help you figure out how to navigate these uncertain times. Now, if there's one thing we know about Warren Buffett, it's that he's a die-hard optimist when it comes to the US economy. This guy has been through every kind of market crash imaginable, from the dot-com bubble to the Great Recession, and he's never wavered in his belief that in the long run, the US will always come out stronger. One of his most famous quotes is, "Never bet against America." And let's be real, he's made billions sticking to that philosophy. Buffett's core belief is that the market crashes are temporary. Sure, they hurt, but according to him, they're just part of the natural cycle of investing. In his eyes, these downturns create opportunities, what he calls buying opportunities. For example, during the 2008 financial crisis, while many investors were running for the hills, Buffett was doubling down on US companies. He saw the panic as a chance to grab valuable stocks at a discount. And that's been his playbook for decades. Stay calm, buy strong companies, wait for the rebound. He's known for buying when fear is at its highest, famously saying, "Be fearful when others are greedy, and greedy when others are fearful." So far, this strategy has paid off. The man's net worth is proof that patience and conviction can weather any storm. Let's take another look at the dot-com bubble in the early 2000s. While tech stocks were skyrocketing, Buffett was one of the few who didn't jump on the bandwagon. Instead, he stayed focused on companies with solid fundamentals. When the bubble burst, many investors lost fortunes, but Buffett emerged relatively unscathed, proving once again that short-term hype doesn't beat long-term value. Fast forward to 2020 during the COVID-19 pandemic. Buffett remained calm while markets plunged. Instead of panic selling, he used that opportunity to reposition his portfolio, emphasizing industries he believed would bounce back. So Buffett's philosophy isn't just about riding out the storm, it's about using that turbulence to position yourself better for the future. But here's the thing, if you've been following Buffett's moves lately, you might have noticed something a little different. The man known for scooping up stocks when everyone else is scared is sitting on a huge pile of cash. In fact, Berkshire Hathaway, his company, is now holding over $270 billion in cash right now. That's a lot, even for Buffett. So what's going on? Some analysts believe that Buffett might be bracing for a short-term market correction. He's not necessarily predicting a total meltdown, but it seems like he's preparing for some turbulence ahead. Historically, he's been known to build cash reserves when he senses an overvalued market, or excessive speculation, or for that matter, a market meltdown. He's waiting for the right moment, when stocks become more reasonably priced. Now, does this mean you should be panicking? Well, more on that later, but if there's one lesson we can take from Buffett, it's to stay calm and think long-term. Even if a correction is coming, Buffett's strategy is to ride out the tough times and come out stronger on the other side. His consistent message is simple. The key to wealth building isn't about timing the market, but time in the market. Now, while Warren Buffett might be staying calm and patient, not everyone shares his optimism. In fact, there's a growing number of voices warning that the US is heading for a much darker scenario. One where hyperinflation wreaks havoc on the economy and causes a complete meltdown. You may have even seen videos like this one circulating online.
Why the governments and the Federal Reserve prefer hyperinflation compared to deflation. So I'm gonna keep this as simple as possible. Let's start with this. So what is the underlying problem here? Simply put, The politicians in the federal government, they have a spending problem. I can't say it any more easily than that. So the federal government spends more than they make. They've accumulated all this debt. Everybody knows that they can't pay this money back. So consequently, the US government, along with the Federal Reserve, they're working in conjunction.
In this video, the speaker lays out a pretty terrifying case. He argues that the US government and the Federal Reserve are actively choosing hyperinflation over deflation. Why? Because cutting government spending enough to balance the budget is, politically speaking, impossible. Let's break that down. According to this view, the US government has a serious spending problem. Simply put, they're borrowing way more than they can afford to pay back, and the only way to keep things running is by printing more money. I mean, that sounds fine on the surface, right? But here's the kicker. Printing money creates inflation. And with the amount of debt the US has accumulated, the rate of inflation is only going to accelerate. If you think inflation has already cooled down, they're saying, well, this is just the calm before the storm. One of the key reasons behind this is that politicians simply can't cut spending by trillions of dollars that it would take to balance the budget. It's politically impossible. Imagine a politician suggesting cutting Social Security or Medicare by 40%. That would be career suicide, and it's simply not going to happen. And here's where the idea of hyperinflation comes into play. Instead of making deep cuts that would be unpopular and economically painful in the short term, the argument is that the government will keep printing more money, creating an inflationary cycle. Over time, this could lead to a complete loss of faith in the US dollar, triggering hyperinflation. Now, hyperinflation isn't just your regular price hikes. We're talking about a situation where the value of the dollar plummets so fast that prices for basic goods like food and fuel skyrocket almost overnight. If this sounds extreme, well, we've actually seen it happen before in places like Zimbabwe, where people literally had to carry bags of trash to buy groceries, and in Venezuela, where inflation ran so wild that their entire economy collapsed. But this argument doesn't stop at inflation. There's a more sinister layer to it. The idea is that the ultra-rich would actually prefer this scenario because it benefits them. When hyperinflation hits, asset prices, stocks, real estate, private equity soar. And guess who owns the majority of those assets? The wealthy. They're the ones who will benefit, while the average person, whose wages won't rise nearly as fast as inflation, will struggle to make ends meet. For example, let's say your salary increased by 10%, but inflation pushes up prices by 30%. Suddenly, your paycheck doesn't stretch as far, and basic goods like food and gas become harder to afford. Meanwhile, the wealthier segment of society sees their investments in assets like real estate or the stock market skyrocket, further widening the wealth gap. So in this perspective, the rich get richer, while the middle class and lower income families bear the brunt of the economic collapse. The wealth inequality gap widens, and the economy becomes even more unbalanced. It's a grim picture, no doubt, but before we get too deep in the doomsday scenario, let's remember that these kinds of predictions, while compelling, are not a certainty. Yes, the US has a serious debt problem, and inflation is a concern, but a total collapse, this is not a given. And here's where the conversation becomes important for you. So here's that big question. Can both Warren Buffett's optimism and these hyperinflation warnings be true at the same time? In a way, yes. It's possible for short-term pain and long-term optimism to coexist. We'll break it down here. First off, Warren Buffett isn't blind to market corrections. In fact, he expects them. He's lived through dozens of crashes, recessions, and panics, yet he's remained confident that the US economy will recover and grow stronger over time. His strategy revolves around accepting these downturns as a part of the process. After all, history shows us that while markets may fall in the short term, they've always rebounded in the long term. But what about hyperinflation? Can that fit into Buffett's worldview? The short answer, yeah, it could. I mean, at least in the short term. A correction or even inflationary pressures don't necessarily mean a total collapse. Historically, we've seen market corrections where inflation spikes, but the US economy recovers over time. Buffett himself has spoken about inflation being kind of like a hidden tax, particularly harmful to those holding cash or bonds. That's why he's always been big on holding productive assets like businesses and stocks. They tend to keep up with or outpace inflation over the long haul. Now, here's where things get a little more complex. Some experts believe we could be heading into a period of stagflation, a scenario where we have high inflation and slow economic growth at the same time. This happened way back in the 1970s when the US faced rising prices alongside stagnant growth. It was a tough time for most investors, but those with long-term diversified strategies came out better in the end. So, could we see inflation rise? Absolutely. Could we see a correction? Maybe even a recession? Yeah. Buffett himself seems to be preparing for some type of turbulence. But here's the key. That doesn't automatically translate to the doomsday scenarios some are predicting. While hyperinflation could happen, it's more likely we'll face manageable inflation where things get tough, but the economy doesn't completely collapse. Let's take another look at Japan's lost decade for some context. After a massive real estate and stock market bubble burst in the early 1990s, Japan's economy entered a period of deflation and stagnation. Growth slowed, but they didn't experience hyperinflation or a total collapse. In fact, Japan's economy, though slow to grow, has remained one of the world's largest. Their story shows that while deflation or stagnation can be painful, they don't always result in economic disaster. So, what does this mean for you as an investor? It means that it's entirely possible for both Buffett's view of a stable, resilient US economy and the warnings of a correction or inflation to be true, just on different timelines. In the short term, you might see turbulence, but in the long term, the fundamentals of the US economy are still strong. Whether we're talking about hyperinflation, stagflation, or just a standard market correction, there are steps you can take to protect your wealth and make sure you're prepared for whatever comes next. One is diversify, diversify, diversify. I know you've probably heard this before, but it's especially important in times of economic uncertainty. The goal of diversification is simple. Spread your investments across different asset classes so that if one area gets hit hard, others might still perform well. Here's what it could look like. For stocks, focus on sectors that tend to perform well during inflationary periods, like energy, utilities, and consumer staples. These are industries that produce goods people need regardless of what's happening in the economy, and they usually have the pricing power to pass inflation costs on to consumers. Commodities. Assets like gold, silver, and even oil often rise during inflationary times, as they're seen as stores of value. Real estate. Property can be a good hedge against inflation because real estate values tend to increase as prices rise. Plus, if you own rental properties, rental income typically adjusts with inflation. International exposure. Don't put all of your eggs into the US basket. Investing in international markets can offer some protection if the US experiences severe economic turbulence. Countries with stronger currencies or more stable economic policies could provide a buffer against inflation or market downturns at home. Also, keep some cash on hand. Now, I know what you're thinking. Didn't we just say that inflation eats away at cash? Yeah, but hear me out. Having some cash on hand during market volatility can actually be a smart move. It allows you to take advantage of buying opportunities if prices drop. When the market experiences a correction, having cash ready to invest means you can pick up valuable assets at a discount, just like Buffett does. Follow the steps and you can help protect your wealth from the uncertainties ahead, whether it's inflation, deflation, or a market correction. Want to find the most undervalued stock opportunities right now to invest in? Click the video on the screen to find out.